Imagine walking into a grocery store to buy an apple. But instead of just seeing apples, you see 4 different aisles. Aisle 1 is labeled mutual apples. Aisle 2 is hedge apples. Aisle 3 is index apples. And aisle 4 is ETF apples. They all look like apples and they all taste like apples. But one costs $1 and the other costs $10. And the worst part? You can't tell the difference until you take a bite. This is exactly what investing feels like for our friend Mark. He has worked hard, he saved his money, he is ready to invest. But the moment he opens a brokerage account, he is bombarded with acronyms. Mutual funds, hedge funds, index funds, ETFs. It feels like a secret language designed to keep him confused. And frankly, that is often the point. Wall Street makes billions of dollars by making simple things sound complicated. But today, we are going to demystify the jargon. We are going to take Mark on a tour of the 4 aisles of investing. We will strip away the fancy suits and the marketing buzzwords to reveal the cold, hard mechanics of how these funds actually work. I'm going to show you which ones are designed to make you rich and which ones are designed to make the fund manager rich. And stick around, because at the end, we are going to run a 30-year simulation for Mark. We will see how a tiny, seemingly innocent 1% fee difference between these funds can cost Mark enough money to buy a Ferrari. Let's dive in. Let's start with the oldest player in the game, the mutual fund. Think of a mutual fund like a fancy restaurant. Mark walks in, sits down, and hands his menu to a waiter. He says, "I don't know what to cook. You prefer the meal for me." In the financial world, that waiter is the active manager. When Mark invests in an actively managed mutual fund, he is pooling his money with thousands of other people. They hire a team of smart analysts in New York or London. These analysts spend their days looking at charts, reading balance sheets, and drinking too much coffee. Their goal is to beat the market. They try to pick the winning stocks and avoid the losing ones. Sounds great, right? Who wouldn't want an expert handling their money? But there is a catch, a big one, the bill. Just like a fancy restaurant, mutual funds are expensive. They charge high fees, known as expense ratios. It is common to see fees of 1% or even 2% per year. Plus, they often have sales loads, which is a fancy way of saying a commission just for buying or selling the fund. So, here is the problem for Mark. If the market goes up 10%, but the mutual fund charges a 2% fee, Mark only gets 8%. And here is the dirty secret. Wall Street doesn't want you to know. Most mutual funds fail. Statistics show that over a 15-year period, nearly 90% of active fund managers fail to beat the simple market index. So Mark is essentially paying Michelin star prices for a fast food burger. Now, let's move to the most mysterious aisle, the hedge fund. If mutual funds are a restaurant, hedge funds are an exclusive underground nightclub. Mark tries to get in, but the bouncer stops him. "Sorry, Mark, you aren't rich enough." Hedge funds are usually reserved for accredited investors. These are funds designed for the ultra-wealthy. We are talking about minimum investments of $500,000 or even $1 million. Unlike mutual funds, which mostly just buy stocks, hedge funds can do crazy things. They can short companies, they can use massive leverage, they can buy art, crypto, or private land. Their promise? Absolute return. They claim they can make money even when the market crashes. But the price of admission is astronomical. They typically use the 2 and 20 structure. This means they charge a 2% annual fee just for showing up, plus 20% of any profit they make. So, if Mark somehow got into a hedge fund and they made a 10% profit, they take 2% off the top, then they take 20% of the remaining gain. Mark is left with scraps. And famously, in 2008, Warren Buffett made a bet. He bet $1 million that a boring, low-cost index fund would outperform a group of fancy hedge funds over 10 years. Guess who won? Buffett won. The hedge funds, with all their geniuses and complex algorithms, lost to the simple, boring market. So for Mark, the hedge fund is a hard pass. Mark is feeling discouraged. The restaurant was a rip-off, and the nightclub wouldn't let him in. He just wants a fair deal. Enter the index fund. This idea was popularized by a legend named Jack Bogle. His philosophy was simple. Don't look for the needle in the haystack. Just buy the haystack. An index fund doesn't try to beat the market. It is the market. Instead of paying a guy in a suit to pick stocks, an index fund uses a simple computer program to buy every single company in a specific list, like the S&P 500. If the S&P 500 has Apple, Microsoft, and Amazon, the index fund buys Apple, Microsoft, and Amazon. Because there is no expensive analyst team to pay, the costs are incredibly low. While a mutual fund charges 1% or 2%, an index fund might charge 0.04%. That is basically free. For Mark, this is a revelation. He gets instant diversification. He owns the 500 biggest companies in America. He performs exactly as well as the economy does. Historically, this means an average return of about 10% per year over the long run. No stress, no picking stocks, just riding the wave of capitalism. But wait, there is one more player, the ETF, or Exchange Traded Fund. Mark asks, is this different from an index fund? The answer is yes and no. Think of the index as the engine. Both index funds and ETFs usually use the same engine. But the body of the car is different. A traditional index fund only trades once a day. When Mark buys an index fund, the price is set at the end of the day. He can't trade it during lunch. An ETF, however, trades like a stock. Mark can buy an ETF at 10 a.m., sell it at 10:05 a.m., and buy it again at 2 p.m. It is liquid, it is flexible, and usually ETFs are even more tax efficient than traditional funds. For 99% of investors like Mark, ETFs are the gold standard. They combine the low cost of index funds with the flexibility of stocks. Examples, the VOO or the SPY. These are the vehicles that turn average people into millionaires. Now, talk is cheap. Let's look at the math. This is where Mark's jaw hits the floor. Let's run a simulation. Mark is 30 years old. He has $10,000 to invest up front, and he commits to adding $500 every single month for the next 30 years. The market returns an average of 8% per year. Scenario A, the mutual fund trap. Mark listens to a bank salesman and buys an active mutual fund. The fund performs okay, 8%, but it charges a 1.5% annual fee. So Mark's net return is 6.5%. After 30 years, Mark's portfolio is worth roughly $580,000. Not bad, right? He has $500,000. Scenario B, the ETF freedom. Now, let's say Mark watched this video. He ignores the salesman. He buys a low-cost S&P 500 ETF like VOO. The return is 8%, and the fee is 0.03%, basically zero. So his net return is effectively 8%. After 30 years, Mark's portfolio is worth roughly $790,000. Look at the difference. $790,000 versus $580,000. That is a difference of $210,000. Mark put in the same amount of money. He took the same amount of risk. But in scenario A, he handed $210,000 of his wealth to the guy in the suit. That is the price of a small house. That is a Ferrari. That is 5 years of retirement expenses gone just because of fees. So, what have we learned? The investing world is full of noise. Hedge funds are for the ego, mutual funds are for the bank's profit, index funds and ETFs are for your profit. For Mark, the choice is clear. He doesn't need to be smarter than the market. He just needs to be cheaper than the active managers. By choosing a low-cost ETF, buying the whole haystack, and ignoring the shiny objects, Mark guarantees that he keeps his fair share of the market's return. He isn't paying for the waiter's tip or the nightclub's bouncer. He is paying himself. Now, you know that ETFs are the winning vehicle, but simply buying an ETF isn't enough. You need a strategy to turn those ETFs into monthly income. How do you use them to actually quit your job? I have created a specific roadmap for Mark where he generates exactly $2,850 a month using high-yield ETFs. Click this video right here, the fastest way you can live off dividends, and I will show you the exact math to financial freedom. I'll see you there.